Hello and welcome back to The Economy for Dummies by Liam Wingert and Jack Soma.
Today, we will be taking a deep dive into famous past crises, recessions, and depressions, and we will be comparing them to the modern day and how they stand up. We'll be taking a deep dive into what path we think the economy is going down and what we think the future is going to look like.
We'll be focusing mainly on the Great Depression of the 1920s and 30s and the Great Recession from 2007 to 2009 and the COVID pandemic of 2020, 21.
Before we start, we must add some context about recessions, depressions, and crises. What can cause them? Well, one reason can be the supply and demand of certain items. A low quantity and a high demand can lead towards increased prices from vendors. These increased prices are called inflation. These increased prices can cause other items around them to increase, though the Federal Reserve, the central bank of the United States, desires around a 2% inflation rate yearly for most economic growth, meaning not all inflation is bad as long as it's controlled. Well, how does the Fed influence inflation? It's quite simple. In order to raise or lower inflation rates, they control the interest rates. Inflation and interest rates have a direct inverse relationship. To lower inflation, you raise interest rates in order to slow down spending, borrowing, and investing. To raise inflation, you lower interest rates to get people spending again.
We should also add that the difference between a recession, depression, and crises is very important. A recession is typically defined as a significant decline in economic activity or economic downturn for two consecutive quarters of negative gross domestic product growth. It is usually accompanied by unemployment, low spending, and reduced production. A depression, on the other hand, is a much longer and prolonged version of a recession and can last for more than 3 or 4 years. A crisis is a sudden event that causes a recession or depression, that can cause a sudden depression, and is typically one area of the economy that starts it. Many economists have speculated that America might be headed toward a recession or even an economic crisis based on the factors that typically cause them and what's going on in current events.
Now, you may be asking yourself, what caused the Great Depression? Well, the Roaring Twenties was a time of innovation and a time for technology that we've never seen before. This technology included credit cards. With the new credit cards, a lot of people didn't know how to use them correctly. So people tended to overspend. These people, in turn, didn't have enough money to give back to the banks. These banks went bankrupt. Ironic. Farmers also couldn't pay back debt after the war, and the stock market crashed, causing direct panic for the people. There's also an overproduction of goods with no one buying them, and the Dust Bowl that killed many crops. Now, what made this depression so significant? Well, 25% of America was unemployed, compared to about a 3 to 4%, which was ideal. This was a near 21% increase, which is insane. We saw we saw a deflation of negative 10.3%, which is wild. And with not a lot of people buying products, we see industrial production halved. A fifth of banks failed, and this lasted a good handful of years. This is what made it so significant.
America didn't see another great economic crisis like this for another 80 years, but in 2007 to 2009 we saw the Great Recession. This was caused primarily by banks giving out untrustworthy loans to people who probably couldn't pay them back due to a housing bubble, which meant higher prices on homes and a lower interest rate, which caused people to buy very fast and with not a lot of money. Because of this, many banks lost a lot of money, and companies that sold houses and assessed credit risk in giving loans went out of business. This led to about 10% unemployment, the stock market fell 53%, and the whole thing lasted 18 months.
Now that we've talked about two of the recessions and depressions, we can look at what they have in common and how to predict a recession or a depression. So, one of the first signs is that we see long-term yields go below short-term yields. This is because investors and economists predict that the economy is headed in a downwards curve. We also see less people buying, which which translates to a lower GDP growth or even a negative GDP growth. Causing this negative or slow GDP growth is the rise of unemployment. We also see the stock market begin to shift. We see many stocks that we thought were strong become very volatile, which could even be seen today through the tariff wars. We can also see a change in banks lending money. They could either lend too much or they can lend too little. The risk of giving too much is that people are expected. The risk with being stingy with loans is that the banks themselves necessarily won't make money. This is because they're anticipating people not to pay them back, while the risk with giving too much is that people actually may not pay them back during a time that they think is going great.
Additionally, recessions are usually connected globally. For example, during the Great Depression, not only America was struggling, all of Europe and Australia went under. Many of the signs you usually see right before a financial crisis, such as lower GDP, rising inflation, rising unemployment, and high interest rates, aren't necessarily the cause. They're usually fuel, but a greater major event in the world is the catalyst. For example, many of these were present during the Great Depression, but it was caused by panic, runs on the bank, and a major stock market crash. Similarly, during the 2008 economic crisis, a few of these were also present, but it was the housing market bubble bursting that caused the actual crisis to start. The Great Depression is a little bit different when it comes to inflation, however, because the unemployment was so high that nobody was spending anything, so they actually had 10% deflation. Many of the signs we see before a financial crisis get much worse. These signs are not always predictors, but sometimes symptoms of something that's already begun and get much worse as the crisis unfolds.
Now, let's take a look at the economy today. Today, we see about on par inflation rate with about 2.3%, which isn't bad. It's almost right on target. We see an employment rate of 96, meaning unemployment is only 4%, which also meets the Fed's goals. We also see a good GDP growth of about 2.8%.
While all this is good, there is still uncertainty about current events going on in the world today, such as the tariff wars that President Trump has started with China, Mexico, Canada, and most countries around the world. There's also uncertainty about war in areas like Ukraine, Israel, and China. Uncertainty in general is very bad for the market as people don't know whether to invest, sell, buy, or move their money in any way. The tariffs could go any way, the best being that they work and other countries bend to America's will, or they go badly and countries cut off trade. But the worst possible outcome is panic in our own country, just like that happened in 1887 and the Great Depression.
The word tariff in the modern day is a very controversial word when talking about economics. With the introduction of ridiculously high tariffs on imports from other countries, including allied countries such as Canada, it is important that we dive into what they are and how they can affect the economy. Tariffs are taxes placed on goods coming from another country. A common misconception is that these taxes are beneficial to the consumers, when in fact, these taxes are then passed on to the product, raising its price, which in turn makes it more expensive for the consumer. Some people see tariffs as a long-term plan in order to help protect American-run businesses. To contradict this, though, it actually makes it harder for smaller businesses to get off the ground. Not every business can afford the prices of American-made products. They rely on imported products for their businesses. The increased prices of these products can make it harder for them to raise funds. A study done by UC Davis also shows that national productivity decreased by 25 to 35% just from raising tariffs about 10% from the years 1870 to 1909. It is also common that the countries retaliate with tariffs of their own when placed on them. In fact, in April, after the high tariffs were placed on China, they retaliated with multiple rounds of tariffs themselves, each with a higher tax percentage after every round. These current tariff wars are no good to the average consumer and could send the country into an economic crisis in the future. While some may contradict this, it's important to look into the past to gauge the future. A tariff placed in 1930 called the Smoot-Hawley Tariff was placed with the idea of protecting farmers and American-made industries, when in turn trade declined near 60%. Now, how did this happen, you may be asking? Chains of supply and demand were very interconnected during the time of the Great Depression and even prior. Tariff also sped up deflation that was happening currently during the Great Depression. They also raised tensions throughout the countries because of such interconnected trade they had at the time.
These new tariffs create more uncertainty, however, since their aim isn't exactly the same as tariffs of the past. The Smoot-Hawley tariff, for example, was meant to protect farmers and industry. But these new tariffs are more to gain leverage and get other countries to help us out and do what we want, with the tariffs being used as a threat in case they don't. This new strategy hasn't been tried before in US history, which creates major uncertainty in the market. Nobody really knows how they'll work out, and we've gotten mixed results so far. This uncertainty could possibly be on the same scale as the catalyst events that contributed to previous recessions and economic crises. This can cause major stock swings as investors hold back waiting for a sign to invest. Lowered consumer spending as people try to save in case of financial trouble, and businesses might even stop hiring to save money. This risk aversion will slow down the economy, harming America over time and potentially bringing the nation into a recession or worse.
And now, we will take a brief intermission as we hear words from a few of our select sponsors.
Here at Countrywide Financial, we trust and value our customer. In fact, our trust goes so far that we'll now only be loaning customers $300,000 to $400,000, even if they only make $20,000 a year.
Are you tired of buying ice for your icebox? Well, here at General Electric, we engineered a new state-of-the-art refrigerator that runs all electric for the small price of $215. Now, if you don't have that money now, that's okay. We now accept credit and monthly payments, so no worries. You all will soon have a General Electric refrigerator in your homes.
Thank you to all our sponsors. Now, back to the topic at hand.
As we now begin our final evaluation of the current economic standpoint, we see that a lot of the signs really aren't there. We have good inflation right where we need to be, low unemployment, high employment, and good economic spending. Although, we believe that this day and age can be different from past crises. We have so many current events going on that it's hard to just rely on the economic aspects. We have to look at the current tariff wars at hand, what they may mean for us, the volatility of our stocks, the wars in Ukraine and Russia, the wars in Israel. There's so many current events going on, which really makes this current time different from the times we have seen before. With the original introduction of these tariffs, we saw many stocks decline. Many people lost a lot of money in their retirement accounts, their investment accounts, etc. This could in turn, with more volatility of stocks, lead to a declined spending, which means a slower GDP growth. While it's hard to necessarily pinpoint how this may turn out, we are starting to see slow and stepping stone signs into a recession.
Additionally, war adds another layer of complication. In the past, it's not certain whether war will help or harm our economy. During World War I, our economy suffered a lot, and many people had to take up new jobs while people are away fighting. But World War II led to a lot of economic growth, from selling weapons, ships, and planes to Europe. So it's not certain whether a war, if we get involved in one, in Ukraine, Russia, Israel, China, wherever, would help or harm us. More uncertainty, which is bad for the economy. To wrap up, 2025 holds lots of uncertainty. That's the key word in all of this. Nobody really knows what will happen next, and we kind of just have to see how it plays out. There's a high possibility that current events like the tariffs and foreign wars could bring us into recession, but not necessarily a crisis if they're managed well. At the same time, the building blocks of some of the other recessions, depressions, and crises aren't really there. Our GDP is good, unemployment's good, and while inflation's not great, it is looking better than it was last year. Anything could happen, and we should be ready for what happens next.
Thank you for listening. We hope you enjoyed.
Tune in next week for another new episode.